2 years ago when we came here, there was a very strong sense of a growing optimism for this region. The idea that possibly Asia had weathered the storm of the crisis that we experienced most deeply in the United States, and that capital was flowing in because Asia represented an attractive alternative for particular American investments. The chief concerns at the time that you had told us about, or delegates in 2009 told us about, were concerned about the US double dip recession and the housing bubble in China. That was 2 years ago. Last year, the same continued strong sense of optimism came out of our interactions here at MIPIM Asia. Again, strong sense that China was leading the way, both in the region and around the globe. And maybe more emphasis than before in terms of the diversity of opportunities, understanding that from a real estate investment point of view, investing in Asia is not simply investing in Shanghai, Hong Kong, Beijing, Tokyo, and Singapore. The chief concern remained at the time the housing bubble in China, maybe less of a concern for what's happening in the US economy because more of a sense of decoupling, possibly, from the rest of the world, but a concern in particular from institutional investors about the lack of availability of quality assets to deploy their capital. And so this is what we asked you this past 2 days. Actually, this was asked yesterday afternoon. Was this optimism from 2010 justified? And by all account, yes. When we asked you yesterday, how is your business activity this quarter compared to same quarter last year, more than half of you said better, and almost a third of you said it was the same. And just 10% mentioned worse. And there are always people who experience bad outcomes. So a very strong vote of realization from the optimism we saw a year ago. I wanted to share with you this chart I found from Real Capital Analytics, who have a booth just outside here, because I think in itself it shows the resilience of the Asia-Pacific region, and it's a way to represent this optimism in the data. And I understand that all those names of companies are a bit small maybe to read on the chart, but what I want you to pay attention is the orange dot. What Real Capital Analytics did is they asked, out of all the top 20 buyers in each region at the top of the boom, how many are still active today and buying in the markets? So wherever you see a little dash, it means that this was a company that was one of the top 20 buyers in that region and has disappeared now. And you'll see that in Europe, a number of players are no longer active, quite a significant proportion. In America, it's much smaller. And in Asia, except for one company, all the firms that were active buyers of real estate at the peak are still today active. And I think that's a testimony to the resilience of the market and the performance of the market here today, and maybe one way to look in the data and characterize the resilience of the region. So when we asked you about the picture looking forward, the question we asked yesterday was, what is your perspective on your real estate market compared to last year? I think the words we were discussing this morning is cautious optimism.
Yes.
Cautious optimism. There's a third of the people are less optimistic than they were last year, but that means that 2/3 were the same or more optimistic than they used to be. Hence our qualifier cautious optimism. And that's basically the main themes that we see emerging out of our conversations with you over MIPIM Asia is a very strong focus on China, as strong as ever, if anything, and this cautious optimism. The cautious optimism coming from nuances, much more nuanced approach to thinking about the markets across many relevant dimensions to real estate investment, nuances at different investment horizon, and a short-term concern mixed with long-term enthusiasm for the fundamentals, particularly in China. Much more nuance across property type, understanding the office from the retail, from the housing, and maybe even within the office market, the office that's quality for institutional investors or for multinational firms as distinguished from the rest. Much more nuance in terms of investment structures. And in particular, it seems that the Pan-Asian fund is dead. And right now, the investors are asking the fund managers to be a lot more specific about the strategy. Strategy in terms of property types and in terms of geography. Much more nuances across Chinese provinces, understanding that there are many opportunities that lie beyond the coastal provinces, but then possibly extreme heterogeneity within those provinces in the core of the country. And then much more nuances across Asia-Pacific markets, so beyond China in the whole region. So let me dig a little bit deeper into those overall themes. Really, China is the unavoidable market because of the scale and the performance of the economy. Continued rising income. To give you a sense of the scale, what we heard about here is, for example, the value of exports coming out of China is as big as the whole region without China, right? And so even if China exports are becoming more expensive, it's very hard to achieve the kind of scale you can get in China any place else than China. And then this favorable long-term trend, the continued urbanization, right? We hear about 1 million people every month. I mentioned already this unavoidable export sector. And then the strengthening of the domestic demand. A recent report by HSBC attributing most of the growth to domestic demand growth, actually, which is a big shift from recent years where most of the growth was attributed to export growth. So these are very encouraging signs from the strong fundamentals. Of course, mixed short-term perspective, and I don't know if you had the chance to read the papers this morning, but you might have heard what happened to developers yesterday on the stock markets in Shanghai. There's clear concerns among the audience, maybe even a bit more than among the people who were on the stage, we found, maybe a bit of disconnect. But in the audience, when we surveyed you, you seem very concerned about global economic crisis, the tension between China and the US, and the crisis in the US, and maybe the inability of the US government to get going in finding a solution, and the inability of European governments to also come up with a solution. And there seems to be a lot of concern within the audience about this. And then these global tensions. You know, on the one hand, the US is talking about understanding this become the Pacific century or the Pacific decades. But the US is saying this, we're trying to remind the Chinese that they're also in the Pacific, right? It's not, except every time I come to MIPIM Asia every year, my own sense is the center of gravity of the world is moving close to here. I'm not sure it's bringing the US coast closer to the Chinese coast. And then these current account balances, right, that remain problematic. And maybe we are a bit too focalized on that. I don't know if you heard about the major issue in measuring the trade surpluses for China, given the way we keep statistics in the world, that we measure the final output. Right? So you might have heard the iPod example, where an iPod is counted as an export from China when actually there's very little value added in China, and that completely distorts the statistics. So keep this in the back of your mind. I think part of the confidence we hear is because of the confidence in the Chinese government to engineer a soft landing. And it strikes me that the October statistics that I showed credit rising a bit added to this confidence, because this was a signal that the Chinese government had been able to slow things down, but also to lift the foot off the brake. And so there's this sense that maybe they are able to fine-tune the economy. And we'll get back to that. But that is certainly a factor of confidence in the ability to generate continued growth and manage the downturn in the real estate markets, particularly the housing market. There remains an issue as to the availability of debt for particularly the small and medium-sized businesses, the SMEs. And then, demography, is it an opportunity? All the wealthier people who become snowbirds in Taiwan or in the south of China, or is it an issue? With China today, is maybe 10 years older than Japan and Korea were when they were at the same stage of economic development. And so when we look at Japan and Korea economic growth path, can we use this as a reference for China, given that China has a completely different population age distribution? It's just an open question. And then there are actually a lot of Chinese regional disparities, and I must admit I came into the region thinking, we have this big mess in Europe, Portugal, Greece, and the list goes on. And somewhat of a mess in the US. I'm not sure we'll ever agree to a deficit reduction package. But come to find out, actually, there are provinces in China which have debt situations that are actually worse than Greece and Portugal. Now, it's a single country, single currency, single market, and maybe it'll be easier to solve here. But in any case, the problem that we see in Europe are not so different than the problems you see across provinces in China. And this matters when you want to think about real estate investment strategies. There's definitely signs every year of a continuing maturity in the market. You see it in the kind of conversations here happening on the floor about sustainability. The number of architects showing their abilities here and displaying their work. Last year we heard about the change in regulation. The change in regulation with regard to the insurance companies. And this year we hear that actually is making a difference. Chinese insurance companies' ability to buy on the local market is providing an exit strategy for foreign investors. And then because of all the supply coming online, that means a greater quantity of investment opportunity, and therefore easier play for the institutional investors. Now there's a clear sign that the market, the performance remains in the sign of the policymakers. After all, they do have a big say on the supply side, on the competition for the local markets. They have a big say on the availability of credit and who gets access to credit, to the point where we hear conversations about how this is affecting the size distribution of firms involved, in particular on the development side, where the big firms getting bigger. And in the end, the investment performance does end up somewhat in the hand of the government. And so what is really critical to foreign investors, and I think we hear this year more than before, is the risk involved in finding the right local partner who will help deliver the type of performance that's of interest to the foreign investors, and then that regulatory risk. And for this, I'm not the expert, but you is the expert. And so at this point, I'll let her take over.